Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the screen and disclaimer. Neither Market Chameleon, Dimitri,
Hey, Will, I can't hear you.
all right. Can anyone else hear me?
Will, I think your
Can you hear me
sound's off.
now?
Oh, hold on. That was me.
Can you hear me now?
That's fine. Yep.
Well, anyways, there's the disclaimer. Take a look. And with that, Dimitri, if you want to get started.
Yeah. Good morning, everyone. Let me share my screen. As I'm doing it, a note to anyone joining us for the first time on the show. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, put it on that live chat on YouTube. Will's keep an eye on it. He'll read them back to me. And while we're going to give you guys a couple minutes to put those questions in. And in the meantime, we'll take a look at the pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So with this pre-market report, as you can see up top, you have this calendar view, which allows you to go back to a historical date. If you click on it, it'll bring up the data for the pre-market that particular date. But here we show the last weeks of data, and this kind of lets you eyeball if there are any particular trends or something unusual happened on a particular date in the last week. You could click on it, take a look. Today, we are on March 6th. So right here at the end, we see so far today, we have 738 stocks trading higher in the pre-market, 225 stocks trading lower. We have 215 million shares trading on up volume, 80 million shares trading on down volume. And if we convert that to dollar value, we have $6.3 billion worth of stock trading higher versus $924 million worth of stock trading lower. So from that perspective, looks like there is a positive or bullish lean in pre-market trading activity. And of course, I think, one of the headlines today, Federal Reserve Powell mentioned that he thinks there will be rate cuts this year, sometime this year. And I think that's boosting stock prices. So let's look at it from a couple more perspectives. Then we'll move on to the questions. I'm going to come down here. And now we see a more granular view of stock symbols that are trading in the pre-market hours with price changes, volume, indicators. We have our most active stocks in the pre-market, biggest percentage gainers and biggest percentage decliners. We have 202 stocks that made our largest percentage gainers list, 53 on our big decliners. So that also points to a bullish bias in pre-market trading. And a couple notes here that to make this list, we do set thresholds for liquidity, volume, price changes, because pre-market things can be very illiquid or trade on low volumes. But if it's trading in a pre-market and meets our thresholds, it can make this list. And that will include small cap stocks. It will include ETFs in there. It could be a leverage product, an inverse ETF. So to narrow down to a small group of stocks, we could use the filters above this list. If you have a watch list and you save stocks to your watch list that you like to follow and monitor, you could filter by your watch list. This filter here in ETF, we're going to use this as an example. I'm going to click on it, get a drop-down menu to select from. I'm going to pick SPY, which is the S&P 500 ETF. And when we do that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we got 28 stocks that made our biggest percentage gainers list, 3 on the decliners. So all the indicators, including this one, so far the ones that we checked point to a bullish sentiment in pre-market trading activity. We gave it a couple minutes, Will. So if you have a question or questions, let me know. I'll start hitting on those.
Yeah, nothing's popped up yet, D.
Okay, so let's go to SPY. Will be usually my default symbol, and actually, you know what? Let's go to NVIDIA actually, because I posted an article yesterday on NVIDIA's positive skew. So let's take a look at that. And I did a small blog on it, but I'll just review it here. And by the way, I just wanted to remind everyone that we have an Interactive Brokers webinar coming up next Tuesday at 2 p.m. If you want to join us, we're going to do some examples using the options profit calculator. And you do have to register with Interactive Brokers to be able to sign up on that webinar, because they're hosting it. It's not going to be on YouTube.
Yep, I'll put it in. Actually, the title Interactive Brokers is using is how to use an options profit calculator.
Yeah,
and I will put that link in the chat.
Yep. So we'll go through some different examples for that on Tuesday. So let's come down to NVIDIA, and we know that NVIDIA, it's been on the news. It's been hasn't. Let's just take a look at their performance here. Let me go to the summary for a second. We could see here, how it's been performing last year, up 259% versus the S&P 27%. And I think it's actually helping. Some of that is helping the S&P 500. But even in the last 3 months, it's been having a spectacular run. And, then the question is, well, how are some of the options traders positioning themselves based on their future outlook from here? Right? Or does it seem that they're buying protection, buying premium, buying out of the money upside calls? So the question would be, if they're buying out of the money upside calls, that traders in aggregate are anticipating further gains, or they're using upside calls to leverage potential further gains. How can we, see if we could find any indicators to support that theory, right? And one of them is the skew. The skew is comparing how are the upside calls priced relative to downside puts. So if upside calls are in higher demand than downside puts, we're going to see a positive skew. If downside puts are in a higher demand than upside calls, we're going to see a negative skew. All right, so let's take a look at that skew and see how that lines up. And I'm just going to give you, before we take a look at the NVIDIA skew, I'll just show you maybe an SPY skew. So I'm going to go here in SPY, right, S&P 500, and let's just see what the skew looks like in the S&P 500, because the S&P 500's been also rallying and going up. So I'm going to go here to skew under volatility, right? And under here, let's go to this one, IB smile graph, right? So here, this shows the skew by particular expiration that we could pick. So let's go out 1 month. Let's see how it looks going out 1 month. So let's pick the April 5th, right? So April 5th, so you can see this April 5th expiration, this is an SPY. The implied volatility at the money is 11.9. Here's the volume. So these are all the expirations. And here we see that this is where the current market is, right? This line. And we have two lines here. One is the blue line, is shown the implied volatility levels for each strike as of yesterday's close. We're not open yet, so this is as of yesterday's close. And the red line, just to show you how it shifted in one day, shows the previous day's close. So there are two things here for April 5th. What we're seeing is that the line shifted higher across all strikes from one day to the next. So implied volatility was up everywhere, right? Not just if we looked at the money's, out of the money's wings, it went up everywhere, right? And also just visually, we're seeing how the skew looks, and it basically, it's from the at the money, it slopes up, right? So as you go down in strikes, right? Down in strikes, implied volatility is increasing. So and this is pretty consistent in SPY. It usually looks that way if you look at it every day. And that's because people like to buy protection against the market falling, and you could use index options or SPY as a market hedge against positions. So this is normal, not always, but this is normal. What the skew looks like. The other way would be, like, I would say, almost an inverted skew for SPY. And what we see is that the skew from the at the money, so remember, this is the current price, this line where it says current, from the at the money going higher strikes, right? Higher strikes, upside calls. It looks like, to me, I'm eyeballing, it looks like it's sloping down, but leveling off, and maybe really leveling off right here. Okay, so to the upside, it looks more as slope lower to flat. To the downside, a steep slope up, right? Indicating, okay, to the downside, people are still willing to buy protection against potentially their portfolio risks. Maybe some people are just flat out speculating that it'll fall, but it usually looks like that. And to the upside, it looks like that the indication is, if we're moving up, it's going to move up at a moderately similar volatility as we see now, or slow down. Okay, so that's what the skew's shown like in SPY. So let's now go to NVIDIA and see what their skew looks like. Is it much different than the market skew? Right now we see the market skew. If we use SPY as the market, well, how does NVIDIA's skew look like? Is it similar or much different? Right. So let's go now to NVIDIA. Okay, now I'm on NVIDIA Smile, and let's go to which one was I on? April 5th. So I'm going to click on April 5th expiration here. Okay, so now we're on April 5th expiration. So here's the at the money, where the current one, see the long line. And what we see now from the at the money is that on the way down, it has it's not like a straight slope. It looks like it kind of curves down and then slopes up. So the idea, so what is it saying? That on the way down, it might, if it's only dipping a little bit, it's not gonna, there's some support there, it's not gonna be very quick. But if it does break through potentially this 800, then we might see an accelerated down move. All right, so between 800 and 859, where we closed yesterday, so far it looks like that the markets are seeing some decent support there, that it's not going to, if it moves down, move down slowly. So there's whatever the strength of the order book looks strong between those strikes, let's say. Okay, that there's support, and that we shouldn't see this big, at least what the market so far is indicating, like a big bubble where it drops quickly. But now look at the upside, right? From 850. Look at this, how steep and quickly goes up, right? Now that's indicating that if this, not only are people betting, right? You see the skew, right? That to the upside, it's way steeper than to the downside, right? And you see how it keeps sloping higher and higher. It doesn't even level off anywhere. So far, everything we have just keeps. So what is this indicating is that not only is the demand look high for these calls, but if it runs, it could run up with less and less liquidity. As it goes higher, there's less and less liquidity, on the book, less and less resistance. Right? That's how visually the skew looks like it's lining up. Okay, so that's looking at it graphically, right? Looking at it graphically, this is approximately 1 month out, right? We're March 6th, so April 5th, let's say it's one month out skew, right? We could look at the other months, but let's just stay with that. So if we're looking at the 1 month skew, now let's see, we could compare, and I did this in the blog, in the article. Then the question is, okay, maybe NVIDIA skew right now, maybe this is what it looks like typically for the last year. It's been running for a year. Maybe this is already, maybe it's not even unusual anymore to look this way. So, and you have this kind of this red line actually shows you the day before, but if you wanted to look back, February 20th, we could even compare. Maybe we didn't have this. So here's February 26th. So we could see that the skew from February 26th and the same expiration, the implied volatility is higher and the skew also. So that's maybe one way to look at visually these by comparing these same strikes. But what if we had a 1 month constant maturity and we wanted to compare out of the money calls versus out of the money puts? So that's another question. The price of the out of the money calls relative to the out of the money puts, is that increasing, flattening, or decreasing? Because maybe the skew always looks that way, and maybe this isn't even, a high skew for NVIDIA. So let's do this. I'm going to go under options, and we're going to look at strategy benchmarks. And a strategy that would structure around a skew is a risk reversal, right? So here's a risk reversal. What is a risk reversal? So this is a benchmark, risk reversal. So we're looking at 30-day maturity, 1 month, and we're comparing a call that's 5% above at the money to a put that's 5% below at the money. Okay, so what we're doing is we're looking at a 1 month. What is the price, the premium for 5% put versus the premium for a 5% out of the money? I mean, a 5% out of the money call versus a 5% out of the money put. Right? How much, if we took the difference of those, if the premiums are exactly the same, 1% and 1%, it's zero, right? But if the premium of the call is 2% and the put is 1%, then the difference is 1%, right? So if we compare them, we see that right now, the put, because we're doing the call minus the put, is positive, meaning the calls are more expensive, 0.6%, which is above the 1 year average, 0.3. So here it is. This is the graph. And you could see that, these we're at a high on the high range, right? This is not the highest, right? Because we've seen higher. Like we could hover over, 0.7 over here. Looks like maybe 0.7. So a couple times. So during the year, we've definitely seen it at these levels and maybe even higher, but it's on a high range, definitely above that red line, which is the average. And on the higher end, but not the highest, we're getting close to it. Okay. Meaning that the demand for those calls looks pretty strong relative to the puts. All right. We could do that for 60-day, maturity. So 60-day even looks like we're even going, and even going out 90 days, it looks the same thing. Right. So the calls basically right now going out from 30 days to 60, 90, like all these, I think we have like a 120 here as well. Yeah.
Really quick, would you just show, I'm putting the link to it. We just show the chameleons where they can read your original articles. I told them it was news. Maybe just click down on news and then original articles, right?
Yeah. So under news, original articles, and well, this isn't it. This is not me, but let me see. I'm gonna put archive, and I'm gonna go look in the archive, and I think I did. I'm gonna just put search NVIDIA option skew right here. So Will, if you want to put that in there, see option skew in NVIDIA near 52-week high. That's the one
Yeah, I put the link to it.
So you see, I'm going over exactly kind of what I wrote about. We're on here, this chart, and then we'll
perfect.
Okay, so yeah. Well, if you find it, maybe put in the link. So let's go back to NVIDIA. So where I stopped was under strategy benchmarks, right? That was so what I did was said, okay, well, what's the strategy that would structure around a skew? And that's a risk reversal, out of the money call versus out of the money put. And here I see that, yeah, it's definitely above its average, 52-week average. And just graphically, I'm seeing it's towards the high end. And as I go out in time, it looks like very similar. So it's basically looks like this skews across the board, the same. And we could look at the graphs as well if we want to go to different expirations. But let's just stay with this. So then my question is, okay, let me see the open interest. Is it just a skew, or is it, how's the open interest look like in, so how does the open interest look like in NVIDIA? So quickly, what I did was and this is in the article, we went to the options chain, and there's different ways to look at the open interest, but let's just do it from the options chain because it's easier from there. So now I'm on the options chain, and we have this open interest tab. So I click on that. And I said, okay, this is right now showing us calls versus puts by expiration. But what I wanted to do is just line everything up by strike, right? So you see here, you have these choices to click on by expiration. Then you could look at particular expiration in here. But if we just took all the expirations and just stacked up the calls versus puts by strike, so I clicked here, and now I have all these strikes in NVIDIA. So you can see there's a lot of them, from 5 all the way down like to 1,600. And what this graph is shown is for each strike, it's stacking the call in yellow and the put open interest in blue, right? So we have the total open interest by strike for the call and the put. So that's what this big line represents, the total open interest, calls plus puts. And the yellow and the blue represent the amount of the call versus the amount of the put. So where are we right now? We're about 850 right here, like right here where I'm hovering over. This is where we closed at yesterday, right? So if I'm hovering over there, then I know to the right of it, the strikes are increasing. Those the higher strikes. To the left of it, the strike price are decreasing. So as the strike prices are increasing, right, what do you guys notice? Do you guys just visually see what's going on? I mean, I guess I'll tell you, but it looks like a lot of yellow. What are yellow calls, right? Not a lot. We're not seeing as much of the blue like we are here visually. What we're seeing is that a lot of it is yellow, meaning that most of the open interest above that 850 are calls. There are like barely any puts out there, right? Which anyway, there are higher strikes. That's probably the many times the case, but what we're seeing is a lot of yellow. And then the question is, well, where are the big lines, right? Where are the big lines? Where are the bigger open interest above 850? So like right here, looks like there's one, 900, right? Kind of sticks out. And then the next one looks like 1,000. So between, 900, 1,000, you got like some inflection points because here you have open interest, right? What happens is, what happens to out of the money calls as you get closer? The gamma increases, right? The sensitivity to the option to the stock price increases, hedging increases. So you have people who are short and people who are long, but the people who are short are also either have to start, covering with buying stock or buying back the option. So there are gamma inflections, right? And we could see there how many calls. So at the 900 level, we have 66,000 calls, open interest in the calls. And if we go to the 1,000, we have 71,000 contracts open in the calls on the 1,000 strike. So really quickly, what we did first, we looked at the skew on the option 1 month out, just to see how it slopes, where the implied volatilities are suggesting the calls versus the puts. Then we looked at, okay, where are we from a historical perspective versus the year? Are we on the high end or low end of the call price relative to the put price? And then we looked at the open interest. Does that support also where, is there actual positions being established on upside calls? And that's basically came to the conclusion that so far looks like, based on the skew where we are relative to the 52-week range of that risk reversal and where we are in the open interest, that traders are positioning themselves for more upside. Okay, so really quickly, just wanted to kind of go through that analysis. We're up at 9:30. I guess no more questions, so I'm going to leave it there, Will.
Great job, Dima. Very interesting. Again, Dee mentioned earlier we're having a webinar next Tuesday. I put that in the link. You have to register on the IBKR site. Thanks for the questions. Great job, Dee, as always.
Thanks,
everyone. Have a great day.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.